Chinese equities, securitized credit, and data centers. These were three topics trending across professional fund selectors and institutional investors on RFP networks last week. We'll discuss the questions that they had, reveal their go-to asset managers on those specific topics, plus touch upon two new themes starting to emerge. You're watching Trending. I'm Brian Urban. Let's get started. If you're a professional fund selector or institutional investor and are new to RFP networks, you can actually start using our global investment research library and asset manager selection tools for free. Simply go to rfpnetworks.com, select Get Asset Owner Tools, enter your business email, create a password, agree terms, and sign up. In Trending this week, we'll deep dive on why professional investors are rethinking Chinese equity allocations, researching securitized credit managers, discussing digitizing their core real estate portfolios with data centers, plus our two emerging themes are playing with crypto and tilting equity portfolios towards quality. Along that journey, we'll refer to the asset manager papers they're reading in order to get answers to their specific questions. Our first trending topic from last week is the question, should professional investors be allocating more to Chinese equities, and if so, how? Let's set the scene with some stats. Firstly, China is predicted to overtake the US as the world's biggest economy in absolute terms over the next 15 years. And secondly, Chinese equities combined have a market capitalization of $16 trillion, making them one of the largest markets in the world. However, foreign investors currently only own approximately 4% of the Chinese onshore equity market, which means their portfolios are substantially underexposed to China. Why is that? But this can be partially explained by the index composition that underpins institutional investors and professional fund selectors' strategic asset allocation. Here's an example. MSCI's index inclusion factor for Chinese equities is currently 20%, i.e. 20% of the market capitalization gets included in the index. And whilst this will increase over time from 20 towards 100, the debate today is not about the 20, but about the effect, i.e. that Chinese stocks only represent 5% of the MSCI All Countries World Index versus 70% of world gross domestic product, GDP. So if that's your index, your exposure to Chinese equities, subject to your tracking error constraints of course, will be limited to around 20% of the actual market opportunity size. But there's another important explanatory variable at play. The Chinese A-share market consists of over 4,100 companies. For an asset manager to establish a local Mandarin-speaking hub in order to perform fundamental research on the A-share market is both costly and complex. As such, equity managers and even global emerging market equity managers play China in a very limited way. Either 1. Through a focused list of A-share companies limited to more familiar names. 2. Through the Hong Kong H-share market, which is more familiar to them. Or 3. Maybe not at all. Which can compound the structural underexposure to the Chinese equity market that already exists in the indices as well. So what is the research that institutional investors and professional fund selectors are reading today in order to learn how to increase their exposure to the Chinese equity markets?
On Chinese equities, there were 4 managers whose papers were most read by professional investors in our research feeds last week. Wellington Management's paper from the Investment Strategy Group. A joint paper by DWS and Harvest Fund Management on ESG in China. And a webinar hosted by Fullerton Fund Management, for which the replay is now available.
The prospect of rising rates and increasing inflation combined with the current low yield environment is pushing professional investors away from fixed interest securities and towards floating rate. And not just for high yield loans. Residential and commercial mortgage-backed securities and other asset-backed securities which are themselves floating rate by nature are on professional investors' radars. To learn more about floating rate, watch RFP TV episode 2. It's on our site, or follow us on LinkedIn or YouTube, etc. But for an in-depth analysis of the relative value and diversification benefits of ABS, RMBS and CMBS versus the major global fixed income indices both during the Fed rate hike of 2017-18 and the taper tantrum of 2013, here are the research papers which were most read by the professional investor community on RFP networks last week.
On Securitized Credit, there were 3 managers whose papers were most read by professional investors in our research feeds last week. Aegon Asset Management's US Fixed Income Mid-Year Outlook. Franklin Templeton's paper, The Fed's Long Hot Summer. and Western Assets paper on structured securities in a rising rate environment.
In a current low yield environment and given COVID-related changes to where we work and how we shop, professional investors have been triggered into rethinking their asset allocation and specifically recalibrating their real estate portfolios. And while some countries such as Switzerland and some segments such as endowments have always maintained a high allocation to real assets, other countries and segments are now considering trading in portfolio liquidity to receive more income, and as such opening up to the idea of alternative real estate forms such as data centers. Now, research on data centers is pretty thin on the ground, so it's no surprise to see Principal Global Investors' recent compendium on the topic trending in our real estate research feeds. Let's turn to our two new emerging themes. Cryptocurrency skepticism has been replaced by institutional curiosity. There are over 70 central banks worldwide either researching, developing, or testing central bank digital currencies. In our currency research feed, there are volumes of institutional papers on this topic from far too many asset managers to mention. But one article that did get a lot of attention was from the multi-asset boutique Ruffer. In this article, their author, Duncan McInnes, states the best investments are often the least comfortable ones. It's an open-hearted account of why they invested in Bitcoin back in November 2020 and exited in April 2021. It's a good read. Currently, there are two V's being hotly debated: value and valuations. Will the value rally continue? Are global growth valuations sustainable? On the back of these two uncertainties, we're seeing an emerging interest from professional investors in tilting their portfolio towards quality, with many of the fundamental managers publishing on this topic in the equity research feed on RFP Networks. However, in the field of factor investing, quality has the least consensus, the issue being how do you actually define it? Now, if you have a thirst for knowledge, which most of our users do have, you may enjoy Mundi's working paper, Revisiting Quality Investing, which is one of the most read papers on this topic in the feeds last week. That wraps up trending for this week. Look out for the next episode of RFP TV on LinkedIn, YouTube, or sign up at rfpnetworks.com. I'm Brian Urban. Thanks for watching.